COMEX gold futures down now, but they did set a record earlier. It's not just real gold. Check out that so-called digital gold and Bitcoin prices. Bitcoin prices right now above the 90,000 mark, actually got above 91,000 at one point, really propelled again by those Bessent comments. So up 4%. It's the first time since early March that we've seen this level above 90,000 for Bitcoin. So keep an eye on that. And then a slew of stocks and companies that have business in China, or at least a notable amount of it, saw some of their intraday moves to the upside after those comments from Bessent. Apple, Nvidia, Tesla, Nike, Starbucks, among those stocks that are up anywhere from 2.5% all the way up to 6%. Tesla, this move in particular, has got a lot of investors curious. They report earnings after the closing bell today. And believe it or not, Kelly, the options market is actually pricing in a less volatile report for Tesla than has been the case on average for the past 8 quarters. So keep an eye on all those names, especially Tesla. I'll send things back over to you, Kelly.
All right, Dom, thanks very much. Stocks are rallying today, even as more dour data comes in. Like the Philly Fed, the non-manufacturing index fell to nearly minus 43 in April. That's the lowest level since May 2020. And my next guests say an economic slowdown will force the Fed to slash rates this year. One's calling for at least 4 cuts starting in June. The other expects 2 half-point cuts after September. Joining me now are Adam Posen, president of the Peterson Institute for International Economics, and Barry Knapp, director of research at Ironside. CNBC senior economics reporter Steve Leisman is with us. Steve, you're not here on set with me. Where's Waldo?
I'm sorry. I'm in what Dick Cheney used to call a UDL.
What
undisclosed
location. Okay. Well, please feel free to jump in as needed throughout this discussion. And Adam, I'll turn to you because you have a forecast for 2 mega cuts later this year. Then you think we'll be back to hikes by next year. So how exactly do you see this whole economic situation playing out?
I think we're on our way to inflation, whether we get recession or expansion, Kelly. I think there's a 2/3 chance we're going to have negative growth on average over the next 6 quarters. In which case the Fed will panic and cut rates, but they will wait until there's been some shakeout from the fiscal policies and the tax and tariff policies. But I also think you're going to get inflation whether or not we get growth. And so the Fed is going to cut as a matter of forecasting, but it's going to be a mistake. And they're just going to have to start hiking rates in 2026.
So you see both the slowdown and inflation. So we're going to hear a lot about stagflation, and the prior experience in the 70s, these rates were many times higher than what they are now. But do you still think the use of that term would be appropriate?
I think in the literal sense, it's appropriate in the sense that normally you do not have, except for a month or so, coincidence of declining employment and rising inflation. But I also think it's important because even though, God willing, it won't be anything like the 70s, it is the similar dilemma for the Fed as it was in 79, that you have to make a hard choice, as Chair Powell, I think, articulated reasonably well last week in Chicago.
I'm curious that you and Barry both agree that the economy is going to slow, but Barry, you're much more dovish. I mean, you see a lot more disinflation coming, I think. Do tell.
I guess I would start with a little bit of a caveat. I never really thought we were going back to below Fed target inflation through this entire business cycle. I do think, though, there are a couple of major disinflationary forces in place. Last week, the Fed released the new tenant index. It's been decidedly negative 2 quarters in a row, so that's going to put downward pressure on rents. I'm not sure that's sustainable through the rest of the business cycle because of the collapse in multifamily construction. But for now, we've got this inflation there. I think if Congress does follow through on spending cuts, that could put somewhat downward pressure on non-housing services inflation. And import prices were starting to cool before the trade surplus penalty tariffs, I refuse to call reciprocal, hit. And so China still has that excess capacity. They have 2.5% negative PPI manufacturing capacity. So I'm not as worried about inflation as Adam is, but at least in the near term. But I am clearly worried about growth. And I would note, in addition to the Philly Fed non-manufacturing survey you mentioned, we had Richmond Fed manufacturing and services today. the business capital spending plans 6 months forward have absolutely cratered. Jan Hatzius has cited that today as a reason why the Fed really can't wait until they see themselves starting to fail on the employment part of the mandate, or wait for capital spending to get even weaker than it was in the second half of last year. So I think they'll probably move sooner than Adam said, but nonetheless, I think they are going to end up moving.
So, Steve, this is the answer to the non-bet from yesterday. Powell's going to end up cutting, and then there's going to be no drama with him and the president.
Yeah, it's almost like you could be optimistic today, because if you listen and stop talking, you'll hear the silence of President Trump not tweeting. And then you see the beauty of the stock market rising, especially on this possibility that you might have indeed some kind of deal. And it's interesting to think of, I'm not quite sure how to characterize it, Kelly, but Bessent's reasoning is fascinating, that we have to have a deal because these tariffs are unsustainable. They're too crazy to last. So you could almost start to put together a little bit of optimism. I'm not sure. Scott Wapner said to me, Steve, there's got to be a deal because we can't not have a deal with these tariffs. So I don't want to be optimistic just because the market's up, but at least for the last, I don't know what you want to say, 13 or 14 hours, it's been possible to feel like, oh, okay, well, Scott Bessent, well, he's kind of one of the adults in charge. It's possible that you get a deal with China, and then maybe things look not as dire. It's well to remember, Kelly, so far, and I want to add to. Go ahead, Adam. I'm sorry.
No, I'm sorry. It's just I've been talking a lot with people who are senior in China or who are close to people senior in China, and I've been talking with trade negotiators, and there's no way in heck we're getting a deal with China anytime soon. Whatever the Secretary of the Treasury says, not going to happen. There's been no preparation, and she isn't going to meet with Trump unless there's preparation. So, I mean, it's nice the market's up, but if that's the reasoning as opposed to finally shutting up about Fed independence, it's probably not going to last.
It's ironic you say that, Adam, because I was going to ask you if we got some, whether it's a deal with China or with Japan or whomever it might be, is that how the market kind of, shakes itself out of this? And maybe does that even diminish the need for all the rate cuts and the stagflation and all the kind of dour situations we're talking about?
Right. Well, I mean, I want to support what you and Steve were talking about, that is clearly the repeated hope that there's a self-correcting mechanism, that adults in the room or market punishment or clear unsustainability policies. But as a matter of social science and forecasting, that's not how things necessarily work. In fact, that's often not how things work. I was talking with a former senior diplomat just this morning, and this has the feel of, when countries are on an escalatory ladder and it's hard for each of them to back down, and feels like the train's leaving the station. So, I mean, I'm delighted if the Secretary of the Treasury can calm this down, but I would not be betting real money on that.
Barry, what would you say about that?
Well, I wanted to interject that what I think is a really important point, and I have to say I was quite entertained by Larry Lindsay's discussion with Steve yesterday. I've known Larry for quite some time, but listen, I think the real issue in the Treasury market is not so much trade policy, the flight from the dollar. The dollar is overvalued on a whole bunch of metrics, real effective exchange rates, purchasing power parity, all that stuff. The real issue in the bond market was made in America, and we've had now 4 series of mini crises in the back end of the Treasury market, and it's related to our supply. So the weakness yesterday, the bear steepening we got in the back end, came in front of a $69 billion 2-year auction we just got, tomorrow's $70 billion 5-year auction, and Thursday's $44 billion 7-year auction.
True.
In the periods when we've been worried about that supply, the bulk of the selling has taken place in the back end of the market. The real concern for me here is that the House signed off on the Senate budget resolution, which requires no spending cuts. They went on recess. We got bad news on the budget deficit. That's the problem in the back end of the Treasury market, not foreigner selling.
So very well said. In fact, gentlemen, not to jump out of this, but we've got
Kelly,
some more. Steve, just 1 second. Eamon standing by at the White House, and he brings us more about those Bessent comments about the trade war with China. Eamon?
Kelly, that's right. I have a source who was in the room who's given me a written rough transcript of exactly what Besson said at that conference yesterday. I want to bring it to you because obviously it's moving the market today. According to this source in the room, what the Treasury Secretary said was no one thinks the current status quo is sustainable at 145 and 125% in terms of the relationship with tariffs with China. He says, so I would posit that over the very near future there will be de-escalation. And I think that that should give the world, the markets, a sigh of relief. He also goes on to say, I do say China is going to be a slog in terms of the negotiations because that engagement started. I would not yet. But I think, again, I think neither side thinks the status quo is sustainable, but I've said quite a bit. So what Besson is saying here is that neither the United States nor the Chinese side thinks that the trade relationship is sustainable between the two countries. And he also says here that he views this ultimately as an embargo between the two countries, that it's ultimately going to have to lead to some kind of negotiation. And he talks about the idea of rebalancing the two nations' trade relationship together. He says they have stifled the consumer economy and favored manufacturing. We want to increase manufacturing. The identity of that would be less consumption. And if somehow I could see a Ray Dalio essay on this like a big, beautiful rebalancing, if we walk out the door of negotiations and sign something in 2 or 3 years that looked like that, I would think that it's a huge win. And then the trade practices, the goal of that is not that hard a break. We want to stay engaged, but it's going to be more fair. So that's a summary, again, from a person who was in the room of exactly what the Treasury Secretary told that audience at the J.P. Morgan event yesterday, guys.
I think that's interesting, Eamon, that his timeline, his time frame was 2 or 3 years for a deal.
Yeah. Yep. He says, if we walk out the door of negotiations and sign something like that in 2 or 3 years that look like that, I would think that it's a huge win. And then the trade practices, the goal is not a hard break. We want to stay engaged. So I think that's an important timeline. But in terms of the sustainability of all this, he says we have an embargo now on both sides, right? So what he's suggesting is that these tariff policies are so high that ultimately it amounts to an embargo on both sides, and that both sides see that as non-sustainable, and that's why he thinks there ultimately will be a negotiation. The question, Kelly, as you guys have been discussing, is how quickly can that happen? And you point out the timeline here he's given is 2 or 3 years. The president has talked about a couple of weeks. So there's a big delta between those two timeframes. And obviously they're working as hard as they can here at the White House to move negotiations along. But how realistic is any of that? How practical is it to get a major deal done with a major trading partner like that in record time?
Eamon, stay right there if you have a second. And I know we have to bring Rick in as well. We've had a 2-year note auction, but I just want to give everyone a chance if they have any questions. Steve, first to you, Steve Leisman, some thoughts here. The Dow is still about 850 points, so call it about 200-300 off the highs.
I'm going to defer to Adam on this because he has different information that is very important. I would just say if it's 2 to 3 years and not 90 days, I would then concur with the dour outlook for the economy and deep rate cuts from the Fed from both our guests, Barry and Adam.
Adam?
Thanks, Steve. Thanks, Kelly. I'm very glad to hear the Secretary of Treasury addressing the fact that it is unsustainable and that negotiations for real rebalancing would take time. Problem is, as I've argued recently and others agree, China has the cards in this situation. They would rather not be in this situation, but once they're in this situation, they're less dependent than we are on them. And so the idea that it's in their interest to de-escalate right now strikes me as odd.
Barry?
Oh, I wouldn't go that far. I guess my base case was to assume that the 10% global tariffs were going to stick, that we would cut deals first in Asia, Europe would be more difficult, and China would take 2 or 3 years. I don't agree that China holds all the cards in this until and unless President Xi is willing to restructure their economy and stimulate domestic demand. They've got manufacturing PPI, excess capacity, a real estate problem, massive unrealized losses in the banking system. I don't really see how they have an upper hand, but you know, this is bad for both. I guess I agree with that.
Can I make a quick?
They survived that for years. They survived the Cultural Revolution, and they've been preparing for decoupling for a decade. So it's not to say what you say is untrue about China. It just doesn't weaken their hand.
Kelly, I want to make a quick comment on what Barry just said, which is his default position is the 10% across the board tariffs. Let's just be clear. That's 3 times what the U.S. tariffs were previously. It keeps the United States at one of the highest levels of tariffs of developed countries. And it was the thing that the market was expecting before Liberation Day, for which it had already sold off something like $3 or $4 trillion worth of wealth from the S&P. So no offense to Barry, I think he's right. He may be right about that. But we somehow have normalized what was previously believed to be an outrageous position on tariffs that is now seen as the default position. And I'm not saying Barry's saying this, but somehow that's okay because it's way the heck better than what we may end up with.
Right, or the 60% from the campaign.
Can I add, Kelly, or respond? Because I'm not saying it's okay by any stretch. In fact, my real concern with this relates to my earlier point, which is, for me, the only way to stabilize our debt and deficit is to get spending on track back to 20.5% of GDP, which is the 50-year median. That what I'd like to hear Treasury Secretary Bessent say, which he used to say quite frequently, was we don't have a tax problem, we have a spending problem. The administration seems to believe they can raise $600 billion a year, or at least $300 billion a year in tax receipts, which will partially plug the deficit. So they're going to get there by a combination of revenues and spending cuts. I think that will fail. It's akin to what Churchill once said about, trying to tax your way out of debt is like standing in a bucket of water and pulling up on the sides of the pail. So my real issue then relates back to our debt and deficit problem, which we created, and trying to tax your way out of it with tariff taxes, import taxes, whatever, is a mistake. So I don't think it's okay by any stretch, but my reason for thinking it's not okay has mostly to do with our own debt problem, which has become really acute.
And let's get back to Eamon for a final comment here at the White House. Eamon?
Kelly, just two more thoughts here from the Treasury Secretary. You guys were talking about the idea of decoupling. In these remarks yesterday, the Treasury Secretary said, I think that I saw a number of container bookings between China and the U.S., and this is from 2 weeks ago, is down 64%. He says the goal isn't to decouple. The goal isn't to decouple. He repeated that twice. And then in terms of the negotiations, the Treasury Secretary said, I'm optimistic that we could do this rebalancing, but in the meantime, there are so many things in terms of surpluses, in terms of the imbalances, and it'll be a question of whether they're ready to do it. So the Treasury Secretary there acknowledging in those private comments, some doubt about whether the Chinese are ready to come to the table on the terms, at least, that the Trump administration wants them to come to the table with.
And we'll go on that note, but Adam, to your earlier point about how you don't see anything in the works on that front, maybe this timeline from the Treasury Secretary of 2 to 3 years is the realistic outcome.
I mean, that would be fine. Not fine, but for definitely an improvement and more realism. I think there are people in the Trump administration, and including Democrats and Republicans in Congress, who do want to decouple. And I think that the debt issues in the U.S. are going to be made complicated if you're making it unattractive for people, including Chinese investors and Chinese government, to put their money in U.S. treasuries.
Yeah.
So there is a tension here. I think Steve is right that we were set up, I said this I think last time I was on with you, Kelly, a month ago, we were set up to settle for the 10% across the board and the 5 big sectoral tariffs by propaganda that's okay, and it's really not.
Well, we'll see where we land at this point with Dow losing some momentum. But again, we're still up 764. Don't want to make too much of it. But as we get more clarity on what was said in that meeting and what the White House's plans may be. Gentlemen, thanks. Adam Posen, Barry Knapp, Steve Leisman, Eamon Javers. Really appreciate your time. Speaking of which, on this very question of Treasury supply, let's get to Rick Santelli tracking how the results of the 2-year auction just went. Rick?
Well, do keep in mind the 2-year has been shadow boxing equities for the last several plus sessions. Equities were up, and the auction wasn't that good. And it had a pop-up yield, as you look at the intraday chart, made a new high for the session. And those 69 billion 2-years were pushed out the door at a yield of 3.795, which is about a basis point and a half above the when-issued market. Higher yield, lower price. The government was a seller. It was not a good auction. I gave it a C-, and I really do believe I was being overly generous here. For a short maturity that's had so much volatility when long maturities are supposed to have that game to themselves, really does explain or go a long way to explain why the auction didn't go that well. Let me hit some lowlights. If you look at the bid to cover 2.52, well below the 10 auction average, basically the weakest since October of last year, as was the dealer position. They took too many, 13.7 versus 12%. All the metrics for indirect and direct bidders, which we now combine, were definitely well below 10 auction average. Tomorrow's 70 billion 5 years, followed by 44 billion 7 years. What I can say is no single auction is going to give anyone the answer on debt and deficits, but debt and deficits certainly have been a big hornet bite on the U.S. economy since well before this administration. And pursuant to that last conversation, Kelly, I can't resist. How do you make a 10% tariff look good? You start at 125.
Yeah.
Back to you.
And there has been a lot of supply this week, Rick. I mean, that's Barry's point about why we've seen the long end backing up.
You know, I don't see any surprises. I know everybody's talking like there's surprises. We've had a lot of volatility. We've had a huge amount of curve movement because each side of the curve takes a day off on being volatile. Yesterday it was more on the long end. Today it's more on the short end. But in the grand scheme of things, yields were higher in January, and I see what's going on in treasuries as something unique, but certainly nothing really negative or giving us any clues to something dire down the road.
All right, Rick, thanks for now. We really appreciate it. Rick Santelli, again, the two-year note auction C- from the Rickster. And
That's
the Dow's
correct.
up about 706 on that. Let's get out to Tesla, which reports after the bell, and it's been a dismal few months there, as we know. Despite today's 4% bump, the company's erased more than $500 billion in market value since January. The stock is 51% off its record high from December. By far the worst performing Mag 7 name this year. Also, the most lucrative trade for shorts, giving them more than $11 billion in profits. And the average analyst price target is still nearly 40% above where the shares are now. Phil LeBeau has more, Phil, on what we might hear this afternoon.
And the expectations are pretty low, Kelly. I mean, look, we saw sales falling in the first quarter, and that's reflected in what the people are looking for, the analysts are looking for, when it comes to the numbers within the numbers. The Q1 auto gross margins, excluding zero-emission vehicle credits, well, they are expected to be lower, perhaps as low as 13 or 12%. There have been a few analysts as low as that. I think the estimate's 16.8%. What do they say in specifics in terms of details about AI and AV investments? Or is it Elon saying this is the beginning of a big revolution that's coming and we'll be a part of it? The more specificity, the better. And then finally, what do they do about 25 delivery guidance? Do they change it? We already know that they expect it to be slightly lower for the year. Remember, in the first quarter, deliveries fell 13%. And the analysts are also going to be focused on production of a lower-priced model. When will it start? Is it being pushed out, as has been suggested by some reports within the last week? That will also get a fair amount of attention. Finally, as you take a look at shares of Tesla, and we're going back to November 5th. This is when President Trump was elected. Will Elon Musk signal an end to his work with the Department of Government Efficiency? More than a few, Dan Ives is most notable, have said on Wall Street, he needs to scale back his government work and get back to running Tesla. I'm not sure we're going to hear that from Elon Musk during the conference call, but if he does signal that, look, there is a period that's going to be coming to an end and I'm going to be more committed to focusing on Tesla, you can bet that shares are going to rally on that comment if he makes that comment during the conference call.
Yeah, it seems like that's going to overshadow anything that might happen in the quarter, but we'll see. The company has a way of always surprising us. Phil, thanks for now. Phil LeBeau, we appreciate it. Coming up, the name our market guest likes for protection against tariffs and the weaker dollar. We'll reveal our mystery chart ahead. Here's one more look at it. But first, if the rally peters out again, one manager says turn to dividend stocks, including this big tech name. We'll have details after the break as the market tries to hang on to its gains.
This is The Exchange on CNBC.
Singapore is deeply invested in the growth of Asia. We believe that Singapore will do well when our region does well.
The debt issue. We have a very severe supply-demand problem. That's a big deal.
And if you can't put the what and the how in a consistent, clear, and meaningful way, then you could end up with high levels of volatility and conflict.
No American voter will ever accuse Donald Trump of being weak on China.
The largest government, the largest economy, the biggest capital market in the world is now holding Bitcoin.
Sponsored by
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
Everything we ever create, it's so a person can do something they couldn't do before.
It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
You guys all have an amazing heart, okay?
Squawk Box, weekdays. Scott Wapner from the NYSE, Closing Bell, CNBC.
David, welcome. And first of all, do you find it an opportunity or frustrating as an investor, the back and forth here, the way we're all trying to tease out these headlines and figure out what's really going to happen with these trade deals?
Both. If you're trying to play the comments on a daily basis, we think you're going to go nuts. We think the best thing to do is take that longer-term vision, buy really good businesses, and buy them on the days that the market is depressed or sad. Do it on the negative comments. Don't chase the rallies like today, because the government and the administration is changing its mind on a daily basis. We think you have to look about 9 to 12 months out, and you have to assume and hope that ultimately saner minds prevail and they back off from some of these tariffs. And basically what Bassett said today was exactly right. The situation is so bad that it's got to change and it's got to ease.
So where do you know that you can kind of go to the sidelines while this all gets worked out? Because you can't really go to the sidelines. I mean, the kinds of things we're talking about affect so many different kinds of businesses, and not to mention if we have a recession.
Well, you're exactly right. It affects all businesses. We think that you have to stay in stocks and you have to look out 12 months and not get overly concerned about the daily moves. If you're looking for a more conservative area within the stock market, we'd focus on some dividend payers. They generally will be more protective on the downside. You're getting paid a good yield while you wait. But we also think at this point you can buy some of the more aggressive areas that have just gotten creamed. We went into the year cautious on Mag 7. We think at this point most of them are pretty attractive.
You know, Amazon being one. You're also looking at AMAT, at Lowe's, Wells Fargo, so kind of a mix of companies there. What about gold? I don't know if you have any exposure to it in the portfolio, but do you look at that and wish you did?
Well, we wish we did a year ago, but at this point, we would not be putting money into gold. We've read a number of things that talk about it being one of the most overcrowded trades out there today, more overcrowded than the Mag 7 last year. We think people are buying it because they're scared about everything else. And if the tensions ever cool and the market starts to do better, we think all of that gold money is going to come out. So we think your upside is very limited. Your downside probably is 20 to 25%. And we think, again, 12 months out, you can make 20 to 25% in the stock market. So we think that's a much better place to be. If you don't want to be in the market, we would keep it in cash rather than putting it in gold as a secure place.
And what about, and by the way, your comments are echoed by the likes of Dennis Gartman and others who have been longtime bulls, but say, look, this is getting out of hand. It's looking almost like a bubble. So just curious on bonds, which often, play some role in the portfolio, but people are a little confused about that right now. Should they be hiding out in T-bills? Like you said, if there's a sense, well, I can't go in cash because of inflation, do I go to T-bills? Do I go to the longer end? And to your point, hope that this all kind of gets resolved and things calm down in the next couple of months?
So for balanced account, we do like short-term bonds, 1 to 4 year bonds. We absolutely would not buy longer-term bonds. There are lots of concerns there. If tariffs play out worse than we hope they do, that's very inflationary. If the president tries to force Powell out, that would be very bad for the bond market. So there are a number of things that are concerning on the longer-term bond market. We'd stay away from there. We'd focus on 1 to 4 year bonds. And again, we would be buying into stocks here into this significant pullback.
Is Amazon the only Mag 7 name, so to speak, that you would look at? I mean, does Tesla get to a point? I don't know if it pays a dividend. It must be small, even if it does. But are there any others that look attractive?
So we like basically all of the Mag 7 except for Tesla at this point. So we think Apple, which has a little bit more uncertainty than the others, is going to be pretty good. We like Microsoft a lot. Google's at a very good price. Meta's at a very good price. So we're buyers of the group. We went into the year owning them, but we were a lot more cautious about their outlook. At this point, we're very upbeat. The reason that we don't like Tesla, and again, who knows what's going to happen today, but the reason that we don't like Tesla is it's a consumer product company that has really pissed off their customer base, which is going to mean there's going to be much less demand. They pissed off the customer base in China, Europe, and most U.S. people that were interested in helping the environment are probably more liberal than conservative. So we really worry about the demand. And that's not that Musk is not focused on the business, but rather they're going to be unhappy with the company for a long time because Musk is the business.
Well, we're going to talk more about that very issue next hour. David, thanks for joining us. It's good to see you today.
Great to see you. Have a great day.
You too. David Katz with Matrix Asset Advisors. Coming up, the Justice Department testing out a new playbook on tech regulation as its breakup trial versus Google continues in Washington. Those details ahead with Alphabet shares near their lowest level in over a year. Stay with us.
CNBC. Live ambitiously.
Master the art of salary negotiation.
Everybody who walks into a salary negotiation is nervous.
Salary negotiations are really awkward.
The number one soft skill is flexibility,
preparation,
confidence.
Learn how to negotiate a higher salary with CNBC Make It's new online course.
I'm going to give you a roadmap for doing the hard work.
Because ultimately, if you don't fight for yourself, nobody else will.
Register right now at cnbcmakeit.com/salary.
Next on Unlocked, dramatic renovations.
I'm not sure we would have done the renovation in the beginning if we'd have known what it was going to take.
3 friends bought an abandoned high school and transformed it into this apartment building. A couple turns an absolute wreck into their dream home, then say goodbye to electric bills. A 117-year-old house gets a total recharge. Now it unlocks more energy than it consumes.
Getting rid of gas and moving to a completely electric building.
Next on Unlocked.
My desire to keep learning, that is what drives my ambition. I sought a career change after 5 years working in corporate law to pursue a passion, which is to tell people stories and help our audiences make sense of the world that we live in.
Brian Sullivan joins Kelly Evans, Power Lunch,
CNBC.
Welcome back to The Exchange. CNBC's newest subscription streaming product is CNBC Plus. You're looking at it now.
Produce cash flows and will grow over time.
Right, and I know a lot has been made, and maybe we can put up the gold chart, that it's outperformed on a price basis, the S&P, since the year 2000, but I think on a total return basis, stocks still have done better.
That's true. If you look over the long term, that's absolutely true.
Yeah, just to your point about the importance of those cash flows. Bahan, thanks for joining us today.
Thank you, Kelly.
Appreciate it. Bahan Janjigian with Greenwich Wealth Management. And still to come, China trade headlines are boosting First Solar today. The shares are up nearly 13, now almost 10%, after U.S. trade officials finalized steep tariff levels separate from Trump's tariffs on most solar cells from Asia. It's a key step wrapping up a case brought against the companies by American manufacturers like First Solar, alleging anti-competitive practices. The International Trade Commission will vote in June to finalize these tariffs. It all has First Solar on pace for its best day since last September. We're back with more.
We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities.
When we took a break, I thought that was the end of it.
To the C-suite.
I started on the factory floor, and here I am 35 years later.
The economist and author Dambisa Moyo.
A lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation on CNBC.
She's wiping her juice hands in my pants. My name's Josh Gerasitano.
My name is V Farm.
This is what we do during our downtime.
Oh. Wow. The flavor here really, really good.
I drizzle the Nook Mam all over it. She got the watermelon juice.
You don't need to say people can say watermelon.
I got the Cafe Moi. Yeah, it's just a bit salty. Hold on, we're going to get changed, okay? It reduces fatigue, it's good for your skin, and it helps the immune system. I normally have like 5 or 6. I just crack it into a plate and then have it all at once. We always come here. It's probably our favourite place. Wow, this is really good.
Risk of excluding Gen AI as well as Gemini is too great. And this really hits at the Google playbook for search that the mega cap has quietly started to deploy for AI and for its Gemini app. New testimony yesterday revealed that Google is paying Samsung again, this time to pre-install its AI app Gemini on new devices. Now, in other words, this is Google trying to secure early dominance in the next interface using a method that the courts already deemed illegal for search. Now, the urgency, meanwhile, is only rising for Google to get this transition right. 2 recent studies show that Google's AI overviews are hurting click-through rates, especially for non-branded informational queries. And that really calls into question Google's claim that AI overviews get more clicks than traditional listings. Now, Google's valuation, of course, we talk about it all the time. It reflects the skepticism around the ability to make the shift from search to AI without cannibalizing its most important revenue. And it also reflects the increasing regulatory pressure. The latest, Kelly, from this remedies case is going to make it even harder for investors to see real recent wins on the AI side. And it's a really, really important shift for regulators. We always talk about how they've sort of missed the boat. They're looking backwards. In this case, they are very distinctly looking forward. And that is a change. And that's, something that we've been wondering that they would do for years.
So where was the report that their AI summaries are hurting the click-through rates? Was that from Google itself?
No, these were from third-party reports on
obviously
an
it
SEO
bolsters
engine website.
Right, like it bolsters Google's case, but it also undermines, it's a major source of anxiety about owning the stock here if they can kind of pull off this transition from their lucrative ad model to something new and different.
Yeah, and it actually goes against, too, what we've heard from Google executives is that we see more click-through. But I think all of this is also just being negotiated and transitioned in real time, right? We don't know yet. Everyone's trying to figure out an ad model. And it's not just Google. It seems to be, if you read the tea leaves, some of the other chatbots may be looking at that also.
Right. And this is one of many, many trials, it feels like. How many are there going on right now and simultaneously? 3?
2 government cases in the U.S. There's Europe. There's Japan. There's China. It's all over. Yeah. Google is just, drowning in this regulatory pressure.
It's a full-time job, and I think that's one of the arguments people make about, that by the time this regulation comes, it inherently almost distracts from the next thing.
Yeah.
Deirdre, for now, thanks. Appreciate it. Deirdre Bosa. Do a quick check on markets, and I believe we can show you the data that Treasury Secretary referenced during the notes that Eamon Javers got from his meeting yesterday, where he talked about how the container volumes at the Port of Los Angeles have been down sharply. I think he might have said even more than what we're seeing on the screen, but the numbers are large. 43% there is the decline through the most recent tracking data that we have. Dow's hanging on to about a 667-point gain, but it's well off the highs. We'll pick up coverage on Power Lunch right after the break.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Wake up to Squawk Box Asia as we set the agenda for Asia's Business Day. I'm Martin Sung in Singapore.
And I'm Sherry Kang in Hong Kong, bringing you breaking news, in-depth analysis, and the stories behind the numbers.
Stay ahead with the insights that you need to succeed.
This is where business leaders and visionaries come together to shape the future.
Now live from Singapore
and Hong Kong.
Weekday mornings, CNBC.
There's a difference between ambition and greed. Greed is wanting more. Ambition is wanting better. And not just better for yourself, for your family, for your community, for your country. There's no reason to want CNBC if you're not ambitious, right? If you don't want better insights, better returns. And that's not just financial, though money is a part of it. We're talking about value.
The day's top stories driving Wall Street. Brian Sullivan joins Kelly Evans. Power Lunch.
CNBC.
Still up 1.5%, similar for the NASDAQ. Names with the heaviest China exposure, like Nike and Apple, that's still where we're seeing some gains today. Apple up 2.5%. Notably, when we first got reports about Besant's comments yesterday, Hewlett-Packard Enterprise is another clear gainer as it makes 30% of its products in China. Again, those shares off session highs. They're up about 1.5%. And got to end with a mention of gold, especially with Fort Knox here on set with me. See, if only you had bought some gold as
fundamentals matter in this earnings report, and whether Elon Musk cares that much what people think about him, since he seems to be a gambler.
Yeah, it's been a long time since this stock has traded based upon the fundamentals. It's largely about tone. It's largely about Elon Musk's vision for the future and the market's belief in his ability to pull it off. And right now, there's a lot of question about his commitment. There's a lot of question about the product lineup. There's a lot of question about how the company is going to bring out those robot taxis, which have fueled so much excitement in the past, but have been many, many years in the making. Maybe we'll get some more nuggets on that today ahead of possibly a June or this summer initial launch of something that's been teased. But I think the market's looking for more details about those robo-taxis.
How much of it, Colin, is about cheap rides, whether we're talking about robo-taxis or the seemingly delayed lower-cost models that investors have been expecting, and this Chinese competition that, especially on a global stage, is causing Tesla some headaches?
I mean, I think a third of the valuation of Tesla maybe is the auto business. The rest is the Cybercab and Optimus. I do think the fundamentals in any stock matter, and I think they particularly matter now versus history because the growth is negative, right? So it's a different story than in the past when deliveries were rising. Now we have a core business where deliveries were down 30% sequentially. We're going to see pricing pressure probably already start. The Model Y refresh isn't off to a great start. We're already seeing you could order it right now and get delivery fairly quickly in the United States. We're seeing financing promos in China. We're seeing pretty severely bad numbers out of the fundamentals, and that has to matter at some point. And, you know, you have to talk about what is Cybercab. They already put a pretty aggressive date out there for Austin in June. You know, a lot of the experts I talk to still have huge challenges with a vision-only approach. And, you know, I think the progress, we'll see how much progress they could do, how much supervision there'll be in that demo. I actually think today there's going to be a pivot, probably a continued pivot toward Optimus, and I still think that's many years away.
Jeff, how much China exposure, and I mean like headline exposure, does Tesla have here, given their huge manufacturing presence there? It seems like the Chinese consumer has been willing perhaps to stick with Tesla for a while, but there's a lot of competition, cheaper competition coming up. And, you know, are they, as an American company, really facing some danger here on the headlines?
It's a huge risk, no doubt about it. And that's where I think Scott Bessent's comments about de-escalation and finding a trade tariff deal with China is really important to Tesla. 30% of their income comes from Tesla. Yes, John, they're the number 3 car company there. That's due to the fact they have a premium offering, and Baidu and all these other companies have a lower, lesser car offering. So will they have another option, a lower cost? Yes, that's important. But I also look at India. If we can get a deal with India, is that going to allow them to penetrate? And you see EVs across the world obviously have been moving lower in price, margins, as well as adoption. But I think we're going to see a revival of that if we can find a way to get Elon Musk out of the White House and back into Texas, into that gigafactory.
And Tim, what would you add?
I'm interested in hearing Elon today talk about supply chain risk because of the trade war. Clearly, Tesla, when you look at the U.S.-made vehicles, they rank very highly. But nevertheless, they are a global automaker. And when you start messing with supply chains, it can the smallest part can derail a lot of things, as Elon Musk has talked about over the years, as we've seen supply chain shakeups, whether it was through COVID or other things. So this is, I think, a key question as well.
Right. And Colin, you've mentioned kind of the problem here is fundamentally on demand, and that maybe some of the cybercab is already priced in. So what could they say today that would help the market turn a page from being down 50% year to date? Or is there nothing that he could say?
Well, I mean, Elon is sort of known for a razzle-dazzle and sort of distraction. As I said earlier, I do think if you look at the last earnings call, he talked almost 40 times about Optimus, about a dozen times on full self-driving, and only 7 times about the Model Y, which was the refresh product that was coming. I wouldn't be surprised if some of the news today we continue to see a pivot toward Optimus, really as a distraction for the fact that the core business seems to be under a lot of pressure.
Jeff, what happens to Tesla if we do experience not just an expected slowdown in growth overall, but something in or close to a recession? It's a premium brand. It's a little bit different from the other car brands out there. And now it's got these, at least for now, political overtones attached to it. Do you have a particular expectation as an investor here in a slower economy? What happens?
Well, I think every S&P 500 company is contingent or dependent upon if we go into recession or not. I don't see that waning strength in the consumer. I still see strength in the U.S. economy. This is a 100% American-made car. And I think one thing that's being underrated is the mega pack. That story, which gets no illumination, we are seeing that year-over-year growth, John, of about 80%. And that's a $15 billion revenue stream that no one's really calculating.
About 2% more than 770 points. After the break, rave reviews for Netflix hitting an all-time intraday high, likely closing above 1,000 for the first time since February 1st. We're going to discuss that name and the overall market climb next.
CNBC. Live ambitiously. Today's Most Active Stocks Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Most Active Stocks Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
What inventions have transformed humanity?
The wheel, the light bulb, the internet, and me.
Learn how to use AI to be more successful with CNBC Make It's new online course.
It's about how we embrace the technology.
What we're really talking about is automation of tasks.
You're going to feel like they were just always part of your life.
We'll give you examples and how you can use AI tools at work and in life.
Register at cnbcmakeit.com/AI.
The age of AI is now.
My mentor always told me that your career is going to be a marathon, not a race. Often, you're not the only one running, so learn from those in front, support those behind, and when it counts, win well and lose well.
Breaking news, market moves. Scott Wapner from the NYSE. Closing bell, CNBC.
and the state of global trade. So where can investors turn with all this volatility? Joining us now with his take is David Spica. He is the chief market strategist at Turtle Creek Wealth Advisors. David, bonds aren't doing what they typically do in this sort of environment. So a lot of investors probably wondering, how do you balance things out? Where do you go for relief from all of this equity volatility? What do you say?
Well, I still think that bonds offer a nice opportunity. Clearly, the spike we had in rates was a bit of a shock, but rates seem to have settled down now. Municipal bonds are very cheap today for high net worth investors. But ultimately, I think you have to look at where is the economy heading. So today, with the S&P down about 15%, if we don't have a recession, stocks look very attractive. If we do go into recession, probably have more downside. Ultimately, what we need is a win. We're like a baseball team on a losing streak. We just need a win to restore confidence in the clubhouse. And right now, confidence, whether it's businesses or consumers, is very low. They want to see some clarity on the tariff front. We get that. I think we can avoid recession, and I think we can see the market go higher, and bonds and stocks should perform well in that environment.
Okay, you mentioned municipal bonds, which is like catnip for me. I got to admit it. I love the topic because I think it also speaks to a longer-term perspective and thinking about tax equivalent yield, particularly for those who are making a lot of money and maybe in some higher tax brackets. What are the sorts of things that investors maybe who are on the higher end of the income scale can do to think longer term beyond just the day-to-day volatility and make some smart decisions in the environment?
Well, you said it. The municipal bonds are for high net worth investors. And here at Turtle Creek, our clients are ultra high net worth. So avoiding taxes and minimizing taxes is a big part of their strategy. And municipal bonds fits well into that. Right now, we rarely see an opportunity to buy municipal bonds this cheap at this high a taxable equivalent yield. So investors need to be considering that. And again, it really depends on your own personal risk tolerance, what you're trying to achieve. If you're younger, you still want to be more invested in the equity markets. If you're a little bit older, approaching retirement, increasing that fixed income exposure, that lower risk exposure makes a lot of sense. And municipal bonds are a great way to play that right now. And again, a once in a multiple year opportunity to get in at these valuations.
See, I just think John is too young of a how can he be in munis? He's in love with munis, David. And now he's laughing all the way to the bank. I mean, I know they've underperformed in recent weeks, but if you're holding it till maturity, I guess you don't care. And you get in now, maybe you get some even better yields. But I just think he's got decades. Right? The stock market
maybe he's making too much money, and that's why he needs the muni bonds. That could be the thing.
As a tax shield. So what is your outlook for stocks, though? I mean, broadly speaking, is it, what do we do? Where you like Netflix? You like EOG? I mean, there's some idea. Netflix makes me worried because everybody loves it here, and it's done so well. But, maybe it's just got just the right mix of things for a difficult environment.
Well, Kelly, because there's so much uncertainty, we want to own companies with visible earnings growth that have limited to no impact from the tariffs. And I really think Netflix fits squarely into that. Look at their last quarterly report just last week when they had the gall to go out and raise guidance for earnings, revenues, and margins for the second quarter. Nobody's doing that right now. Nobody has the confidence to do that. They also reiterated full-year earnings growth of over 21%. So clearly, the metrics are very strong. And I would argue Netflix is a very defensive name right now. Who's giving up their Netflix account even if we go into recession? I don't think people are going to do that. That's going to be one of the last things they do. That's very cheap entertainment. And today, with their growth growing 20%, 300 million global users, I think it's an excellent place to be hiding out to a degree at this point.
I just moisturized, Kelly. I guarantee you I'm not as young as I look. And David, let's put some numbers here. We talk about tax equivalent yield. A typical investor might not be thinking about this, but we could be talking 7-8% pretty much guaranteed. I mean, nothing in the market is guaranteed, but defaults across a portfolio of munis, very, very rare. Talk about how rare it is to be able to lock in 7 or 8% for decades on top of all this volatility that we see in stocks.
Extraordinarily rare. Our muni bond expert here a few years ago said this is a once-in-a-lifetime opportunity to buy. The last time we saw muni bonds get this cheap. We're seeing it again. A second once-in-a-lifetime opportunity in a span of 4 or 5 years. That's pretty unusual. But the thing you have to understand is who issues muni bonds? It's state and local governments. Well, you consider the fiscal health of the U.S. government not great, but state and local governments continue to be in very strong fiscal health. So not only are you getting that great yield, you're getting it from an issuer who's in great shape where the risk of default is extremely low.
Even
so
with
that,
Medicaid,
again, it's a very much a win-win.
Even with the tide going out on Medicaid, even with the cuts that we might have to make to services and so on?
Absolutely. I mean, Kelly, you've kind of got to look across the landscape of things. There's a lot of risk out there right now. Where is the place I can be where I can get my best risk-adjusted return? I think a name like Netflix falls in that category, and I think municipal bonds issued by state and local governments with solid fundamentals, solid budgets is another place. Nothing's risk-free. Heck, are U.S. Treasuries even risk-free anymore? We saw a little bit of concern about that in the last couple of weeks. But at the end of the day, it's about maximizing a risk-adjusted return in a very uncertain environment, and muni bonds fit well within that category.
Pull back the curtain for us. Finally, David, you talked about your clients being ultra high net worth. What are the biggest questions that they're calling you with over the last few weeks as we've seen all of these violent moves in the markets?
Well, ultra high net worth investors can get a little bit nervous, just like regular investors can, when we see the market drop 19% on a tariff plan that could completely upend global trade. But at the end of the day, our investors are mostly focused on managing taxes and on gifting those assets to the next generation in an efficient way. So family governance and tax management and estate planning are the big issues for them, and that tends to be where they're focused. Ultimately, though, we are in line with what others tend to believe, is that we've got to get clarity around this tariff issue, particularly with China. I hope what Scott Bessent said today comes to fruition, because that would be that would be winning the World Series in my mind. We need a win. That's a World Series walk-off grand slam if we can get something done with China.
No, he did say 2 to 3 years, but we'll see. I take your point. David, thanks so much for joining us today.
Thank you.
David Spica, Turtle Creek Wealth Advisors. Betting on uncertainty. Our next guest says you have to look long-term. Where they're putting their money is coming up in Market Navigator next.
The top fintech companies list is back. CNBC and Statista are looking for the world's standout firms, following in the footsteps of some of the biggest industry players. To find out more and submit your application, head over to cnbc.com.
Wake up to Squawk Box Asia as we set the agenda for Asia's Business Day. I'm Martin Sung in Singapore.
And I'm Sherry Kang in Hong Kong, bringing you breaking news, in-depth analysis, and the stories behind the numbers.
Stay ahead with the insights that you need to succeed.
This is where business leaders and visionaries come together to shape the future.
Now live from Singapore
and Hong Kong.
Weekday mornings, CNBC.
Ambition for me means following your dreams and working really hard to achieve them. When I was growing up, I used to dream about studying abroad, speaking different languages. These early aspirations have shaped my whole life.
It's a new science that could disrupt the medical industry.
The project is to understand the genetic makeup of Asians and to find out which of those genetic markers are ethical markers and not disease markers.
We're taking the bone marrow cells from the patient, making the edit, and we're putting it back into the patient, making a drug just for you.
I think that this technology is going to totally reshape how people have children.
The Edge dives into the world of genomics.
Before they talk to Wall Street, they talk to John Ford and Morgan Brett. Closing bell overtime.
Can tell us where they're looking right now, and REITs are coming up. What else is popping up for you?
Hi, thanks for having me on the show. Yeah, so REITs are obviously the focus currently, primarily because we are seeing quite a lot of movement on the interest rate side. So can dig deeper into that. But in addition to this, we're seeing quite a lot of interest in and exposure and opportunities in things like, for example, consumer staples. So anything that is less sensitive to interest rates moving higher is currently being highlighted as the place to be. And on the other hand, as a way to protect against those things, really long volatility, either in the equity space or in fixed income space. And the last couple of weeks, I think, have made it obvious why that is.
Yeah, this is why, the AI is going to replace all this. So because I think about some of those areas you mentioned, staples and REITs, and I think, well, they could be under pressure if yields keep going higher. You see it differently.
Well, actually, there's a distinction here that the system is highlighting between equity REITs and mortgage REITs. So one of the things that makes mortgage REITs particularly sensitive to higher interest rates is that they are, one, very highly levered, but also because they pay fixed coupons, they invest in mortgage securities. They tend to perform relatively poorly in a rising interest environment. With equity REITs, in contrast, the underlying asset are actual properties where you could over time see increases in rents, increases in property prices. So there's an implied hedge in the actual security.
Yeah, in consumer staples, what's the idea there? And is it the sector broadly, or any of these kind of queuing up specific names?
This is, I think, a little bit in...
Welcome back to Power Lunch. I'm Julia Borston with your CNBC News Update. The U.S. will hold talks in London tomorrow with Ukrainian today that he will resign from the program because he has lost his journalistic independence. That's according to a memo to staffers obtained by the New York Times. The resignation comes as 60 Minutes and CBS have been sued by President Trump for $20 billion. And parent company Paramount is also looking to get administration approval for the sale of the company to Skydance. And Instagram is taking aim at TikTok, launching its Edits video creation app that offers features similar to what's already offered by TikTok's CapCut app. The Edits app for Instagram includes AI and other tools for short-form video production. John, back over to you.
All right. Kelly just downloaded it.
I did. I feel very special.
That's
impressive. I don't know if I'm going to use it. I don't know if I need it, but...
We'll see. I expect big things from you. Time now for our 3-stock lunch, where we hit 3 different stories and why they matter to you. Today, we've got 3 CEOs who were on CNBC earlier today. Here with our trades is Strategy Asset Manager CEO Tom Hulick. Up first, Goldman Sachs CEO David Solomon, not sounding the alarm bells on the markets.
Markets tend to overreact in the short term. We've all been through, stress. In markets, they overreact, but you get to a different place when you look forward 6, 12, 18 months. You get to a different place where the market has digested that change in the macro environment. It will be no different here.
So, Tom, how should investors react to Goldman Sachs?
Well, this is how we approach our thinking. For the overall markets to regain strength, you want to see the financials to participate, and Goldman is very, very strong financially. We prefer JP Morgan, but, they had strong trading revenues, and their investment banking is having challenges, but who wouldn't in this environment? So if you look at Goldman's earnings, they reported $4.74 billion in net income. Their earnings per share were very solid, but the headwinds from the tariffs and the global M&A softness are caution for us. So we see an opportunity in Goldman, but we prefer JP Morgan right now.
All right, Goldman up 3% today. Let's move on to Chevron with the CEO also on Squawk earlier, explaining what oil prices in the low 60s could mean for their capital spending.
We can't really swing our capital spending based on the price of today. It has to be based on our view of price out into the future. And our fundamental views on longer-term supply, demand, technology, policy are really unchanged. And so our longer-term view of prices are what drive our capital spending.
So on Chevron, Tom, what do? You a buyer?
We are. So we own Chevron. They're positioned to benefit from the U.S. policy support for offshore development. In any uncertain environment, dividend-paying stocks are the way to go. And Chevron offers stability and cash flow for our clients. And as a forward-thinking manager, we just don't like to ride trends. But there's a strategic viewpoint of this. I mean, right now, if you look at Chevron's yield, 5%, 38 years of consecutive increases, this is exactly the type of shareholder discipline we prioritize. And Chevron's a really good company to own in the long term with the exposure across the oil, natural gas, chemicals, refining and renewable space. This is a diversification that smooths out revenue cycles for us.
Last trade today, home builder Pulte Group shares popping after posting a beat on earnings and revenue in its first earnings report this morning. In its earnings report, I should say, not its first. Here's CEO Ryan Marshall on what he's seeing from the consumer.
As we moved into April, we saw a little more volatility and choppiness, and I think it's to be understood that the consumer was dealing with a lot, whether it was stock market volatility or concerns around the interest rate or fears about tariff-induced inflation. There was a lot for the consumer to deal with. We saw a lot of consumers continue to move forward. There were some that have elected to take a pause.
Tom, can you buy home builders, even Pulte?
We don't own Pulte. This is a very well-run company, but we've got to have greater conviction out there in the mortgage affordability area, and we need interest rates to come down. And housing demand remains structurally strong right now. If you come out to California, where we're from, there's not enough homes for people. Pulte reported very, very strong earnings, but we believe the stock's too dependent on declining interest rates, and we want to see that for further upside.
Zoom out for a moment. The Dow's now up around 935 points. The S&P 2.25 plus, the NASDAQ 2.5. This is after a rough day yesterday. How should investors use discipline and navigate these markets?
We continue to favor a kind of a mix of high-quality dividend stocks, and so investors should just be patient right now. We need to see more clarity on the trade tariff talks. We want to see interest rates come down. We can manage through this uncertainty with discipline and optimism, and I'm very hopeful that we're going to have a very strong year-end.
All right. Tom Hulick, thank you. Also, remember, you can recap every three-stock lunch anytime you want. Got to scan that QR code on the screen, though. It's there right now. Or you can head over to cnbc.com for more also, I guess.
And the 10-year Treasury yield slipping as tariff uncertainty remains. We'll dive into the bond market with Rick Santelli after this.
It's our all-new weekday lineup. U.S. Markets Edition. Squawk Box Asia, The China Connection, Inside India, Access Middle East, CNBC, First in Business, Worldwide. Before they talk to Wall Street, they talk to John Fort and Morgan Braddock. Closing bell overtime.
Top line lowered its full-year profit outlook, and RTX warned of an $850 million hit from tariffs this year. You can see both stocks down. But our next guest sees a buying opportunity there. Ron Epstein is a senior aerospace analyst at BofA Securities. Ron, first of all, what happened with Northrop? Let's start there. Welcome.
Yeah, hey, thank you. So Northrop today reported, and they took a charge on their B-21 bomber. The charge was $477 million. That wasn't expected, and that weighed heavy on the quarter. And Northrop had been seen as a relative safe place to go, and I think that surprise rattled investors. That charge was related to some things they said were, some material costs, but a lot of it has to do with they're making a bet on ramping up production. And, the question really becomes, the key to Northrop is, the bet to ramp up production. They're betting that the Department of Defense is going to want more B-21s than the current program of record. The current program of record is 100 of these airplanes. And if they up that to 150, maybe 200 airplanes, they're putting everything in place to get there. So we'll learn soon, the fiscal 26 defense budget or the fiscal 26 federal budget, which will have the defense budget in it, that request should come out sometime probably, mid-May, maybe early May, so just a matter of weeks away. Yeah, I do. I mean, having the shares off, last I looked, they were off maybe 12 or 13%. That's way overdone on a program. And even if they got the bet wrong, the program's only about 12% of the revenue in total. And over the life of the program, worst case is they break even, but most likely they'll make some money. And the way the program is structured, there's a low-rate initial production of the airplane the first 21 airplanes. They're going to lose money there, but the next of the program record, the next 79 airplanes, they're going to make money on somewhere, call it low double-digit margins, low teen margins. So when you roll it all up, they probably will make some money on this program, but it's just going to take some time, and that's probably the worst case. But like I said, if there's more of these things in the budget, then they place the right bet, and you could see the stock go the other way.
Ron, European countries, Germany in particular, poised to ramp up defense spending, but likely with European defense companies. Any risk there for the likes of RTX and Northrop?
Yeah, so it's a great question. Europe is spending a lot more on defense. You kind of look across the Europe, call it Europe writ large. Their countries are moving from 1.5 to 2 or 3 or maybe 4% of GDP. The countries right on the kind of the front line with Russia are spending a lot more than that. You look at Poland; they're spending somewhere of 6 to 8% of GDP. The European industrial base is building itself out, but that's going to take time to do. And until that happens, there's going to be continuing demand for U.S. equipment. So if you look at a company like RTX makes Patriot missiles and things like that, and there's going to be more demand for munitions and missiles and that sort of stuff. So I'm expecting there's going to be a continued good market for foreign military sales, both direct commercial sales and FMS sales to the U.S. government into the European market. Given where their industrial base is, they're going to need it.
How much of a sentiment risk, a valuation risk, might there be for these companies?
Yeah, so I mean, from Europe, I don't think it's too much, right? I mean, a company like RTX, they're all over the world, right? So Europe is a place where they sell stuff, but they sell stuff into the Asia Pacific. India is another place where they sell equipment. So could you see increased demand in other parts of the world if the European demand slows? I think there's a broader kind of maybe how do you call it, a technical trade around flights to safety and risk on, risk off, tariffs on, tariffs off. That's kind of impacted the defense group. Year to date, if you look at defense names, they've generally done pretty well. Given all the volatility in the market. So I think even with the big sell-off today, year-to-date, Northrop's roughly flat.
All right. Ron Epstein, BofA Securities, thank you. Well, the Dow is rallying now up about 990 points on hopes for an end to the U.S.-China trade tensions. We will get a final check on the markets when Power Lunch returns.
Live ambitiously. Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive.
Shifting power dynamics. What's different about Trump 2.0, particularly for the Middle East? Ambitious economic drive and the personalities pulling the strings.
Tariffs, trade wars, for whatever word you want to use. I think these are all challenging, not just for China, I think for the world.
Join me, Dan Murphy, for Access Middle East, your edge in Middle East markets.
Breaking news, market moves. Scott Wapner from the NYSE. Closing bell, CNBC.
That the administration have been putting forth that, boy, this is plenty sustainable and it's worth sustaining for the long term. The market's not exactly looking forward to that short-term pain. Also, after the bell in overtime, we've got Tesla earnings, which are hotly anticipated. Now, Tesla, toward mid-late December, topped out right at around $480 a share. It's at about half that, close to $240. These earnings results seen as being a pretty interesting signal. Also, whether Elon Musk is on the call, whether Elon Musk indicates that he's going to leave Washington, D.C. maybe and spend some more time focused on Tesla.
Still trading around 100 times on the forward PE. So we've talked to a lot of value investors here on the programs lately who will look and say, okay, an Amazon or an Alphabet or an Apple are names that look interesting. Tesla kind of still remains in its own boat. We're mentioning gold, and let's show that on the screen real quickly. Last couple of days, we've had a couple of superlatives in a row. First, 3,400 an ounce fell. This morning, 3,500 an ounce fell. But that said, some of even the diehard, the longtime bulls are just saying be a little bit cautious here. It's starting to act parabolic, and today's reversal could be emblematic of that. So you see a little bit better market tone. You see gold coming off the highs. You know, nobody ever knows if this is the turning point, but it's a reversal that's worth paying attention to.
Are the rules changing, though, to the safety trade? You know, the dollar used to be a part of that. You know, U.S. debt used to be a part of that. Maybe it still is. We got questions on whether there's this flight away from the U.S., but if there is, might these unusual moves, flight to things like gold, be part of, well, if I'm not investing in the U.S.,
Totally.
maybe I'm buying gold.
And look, central bank demand has been a huge portion of that. But as Rick said, when the Treasury data came out, there was still buying by foreigners, by the Chinese. So a lot of this could also be an inflation story. It goes back to the announcement of those extra tariffs. That's probably going to be the fulcrum point to watch. But you're absolutely right. So there we see about a 0.2% rebound in the dollar index, still below 99.
If this language from the Treasury Secretary from this closed-door meeting is what we think it is, the idea that he's acknowledging what we have effectively now is a trade embargo.
Right.
China trade is basically on the verge of halting, and that that's not sustainable. Well, I guess that is heartening. Despite America first, maybe not America only, maybe globalism isn't doing well, but maybe global trade isn't dead.
All right, that's the hope at least. Want to also quickly mention we got some numbers for, I don't know if you've been watching the playoffs, NBA playoffs. Have you?
I've been watching clips of Stephen Curry shooting crazy threes while like flipping over. And
did you know that there are 37 three-point attempts on average for a game now, up from 22 when Curry was first doing his thing? That's why it's become, so let's see, I don't know what, Paul, what is the number? Tell me the number. Most watch opening weekend in 25 years. So I guess it doesn't, the three-point contest can continue.
People occasionally still drive to the hoop, though, I hear that's true.
John, thanks so much for joining us today. A lot to cover, of course, on Overtime. We'll see you then. Closing bell starts now.
All right, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make-or-break hour begins with more trade twists and turns. A still volatile stock market today. The picture with 60 to go in regulation looks like that. It was an already good bounce. It got even bigger around midday today when reported comments from the Treasury Secretary about the trade war with China sent stocks shooting even higher. You could see the move. A little bit of a pullback after that, lasted about an hour until a report from our very own Eamon Javers moved the market yet again and took a little bit of steam out of this rally. He's going to join us momentarily from the White House with the very latest in what is still a fast-turning story because the market, as you see, is moving back towards the highs. The Dow's good for a little more than 1,000 points right now, 2 2/3%. Then there's the other big story after the bell tonight. It is Tesla. Those earnings in overtime, always a highly anticipated release. This time even more so given the stock's big decline this year and Elon Musk's elevated role in the political arena. Phil LeBeau will have the latest for us in just a moment as well. We do begin, though, in Washington with our Eamon Javers on the North Lawn today. Eamon, you moved the market earlier. Now we're coming back a little bit. What is the very latest from your perspective on the North Lawn?
Well, Scott, what we heard is White House Press Secretary Caroline Leavitt sending an encouraging signal about trade negotiations with China during her briefing this afternoon. She said President Trump wants to get to a deal.
He wanted me to share with all of you that we're doing very well in respect to a potential trade deal with China. As I mentioned, there have now been 18 proposals in more than 100 countries around the world who are wanting to make a deal with the United States of America. And the president and the administration are setting the stage for a deal with China. So we feel everyone involved wants to see a trade deal happen, and the ball is moving in the right direction.
And worth noting there, Scott, she didn't offer any specifics of what setting the stage for a deal means in real terms. And of course, there's no schedule for presidential level communications between the two countries. Meanwhile, CNBC has obtained a rough transcript of Treasury Secretary Scott Bessent's remarks on trade at that closed door event earlier that moved markets today. Here's what he said. He said, the next steps with China are no one thinks the current status quo is sustainable at 145 and 125%. 1%. So I would posit that over the very near future, there will be a de-escalation. And I think that should give the world, the markets, a sigh of relief. We have an embargo now on both sides, right? So Bessent clearly suggesting there that the current situation amounts to an unsustainable trade embargo between the United States and China, the two biggest economies in the world. And both sides, he says, have an incentive to cut a deal. Scott, back over to you.
Okay. Eamon, thanks so much. And great work today at the White House. On the ground reporting from our own Eamon Javers there. We're getting some headlines as well from the Richmond Fed president, Tom Barkin. Steve Leisman is here with that. What people seem to be centering on, Steve, related to Mr. Barkin, is comments about the consumer and spending and worries because of everything that's going on right now. What stands out most to you?
Well, this idea that he said, the Richmond Fed president, Scott, that there's a lot of reasons to be worried about consumer spending. I'm guessing he's taking that from a lot of the surveys and the sentiment surveys that have been out there. Maybe even more worrisome, Scott, was his comments that inflation expectations may have loosened. The Fed has been relatively sanguine about not the short-term ones, the short-term inflation expectations. It's the long-term ones that have been difficult. He also says firms have been defensive, delaying and deferring investments. That's something we've heard a lot of, Scott. There were two reports this morning. Richmond Fed came out with a report as well, Philly Fed, non-manufacturing, and the Chicago National Activity Index. All these numbers are really negative right now. Again, these are survey numbers. And Scott, it's why I would point your attention to Thursday, the durable goods report, not something that you get up in the morning and I suspect you're very excited about, but I will be, because it will reflect some of these real numbers that are out there in the economy. And we'll get a chance to see whether or not Barkin is right that we did have a decline in.
For sure. And I want to, maybe for a while.
And I want to get this market to the lower drama, lower volume, almost the feeling of neglect or giving up. And, you know, I recognize that the sentiment data has been very lopsided here, but I don't get the sense that investors have given up here yet. And, you know, that's one of the necessary ingredients of ultimately putting in a good low. I don't think we have to go a lot lower here. 4,800 discounted a lot of bad outcomes, but the process of repairing the trends and basing after the damage so many stocks and sectors have endured, I think is important. And, you know, let's add to that, Scott. One thing we haven't seen yet, we haven't seen the stuff people, the stuff that people view as most defensive or safe. We have not seen that really get hit yet. That could be Costco or Walmart or gold. I think ultimately the safe stuff has to get hit here too.
You make an interesting distinction between, you know, what some on the street and the notes this week have talked about, the psychological versus physical. Yeah. That psychologically sentiment's terrible, but large institutions and clients per se of, you know, Bank of America, for example, and they track the fund flows, hasn't necessarily turned into mass selling. Psychologically, not necessarily physically. Right? There's a difference between the two, obviously, in the outcome of a market.
Yeah, and that's what I think still has to thaw here a little bit. I mean, we were 2.5 years up with basically little interruption, and we're 5 or 6 weeks down. Now it's been a large decline. I do think 4,800 is probably a good low, but the process of retesting and basing is in front of us. I would also just note, when you're looking for unusual or extreme price action, what we've seen in gold, Scott, the last couple days is both unusual and extreme. And this has all the makings of some type of a blow-off there.
Well, what we've seen with, you know, what yields have been doing, what the dollar's been doing, what gold's been doing. Why do you pick out gold more so than the other two asset classes, which have all sort of collectively come together to raise concerns?
I find it notable that, you know, gold's been in this bull market for 2.5 years, and we've been lucky to have a good call here. We've changed our tune the last week or so. This looks like a blow-off now. Gold's 30% above the 200-day moving average. You go back the last 50 years, that's kind of the upper limit. Expect some type of a correction from that condition. The flows into the GLD over the last number of weeks are remarkably excessive. And just the last couple of days, call volume in GLD is like 6 sigma from any historical average. So the ingredients are there, I think, for some type of a setback here in gold. Note yesterday, on the very strong up day in gold, all the gold stocks actually reversed lower. You saw Newmont reverse lower. Something's going on there. I think you're walking into some type of a correction there.
All right. I appreciate you being here and working with us here as we've had this breaking news. Chris Verone from Strategas right here at Post 9. Now to Tesla earnings. Shares higher today. Slammed, though, over the past few months. Our Phil LeBeau is here with what is on the line tonight. And Phil, Dan Ives today, the well-known analyst, calling this one of the most important reports and conference calls for Tesla ever.
And it's easy to see why, Scott. I mean, there are so many questions that are swirling around Tesla, Elon Musk, the future for the company beyond the automotive business. Let's start first off, though, talking about what's expected in terms of the Q1 numbers. They're not going to be pretty. We know that because there are slower sales in the first quarter. EPS 39 cents a share is the estimate. Revenue just over $21 billion. Free cash flow. There's even a few people who are suggesting they may not have positive free cash flow in the first quarter. And there you see the automotive gross margin, 11.6%. Remember when it was under 20%? People thought the sky was falling. Here are the three questions. I call it 3 of 3 for you, Scott. First of all, will Tesla's robotaxi start in June? They have committed to June as being the start of robotaxi service in Austin, maybe even on a very small level. Is that still the case? Or does it get pushed out a month or two? Second question, in terms of Tesla production, is a lower priced model delayed? Or are we still expecting to see it perhaps sometime in the third, maybe early fourth quarter? And then finally, as you take a look at shares of Tesla, will Elon Musk signal an end to his work, or at least scaling back his work with the Department of Government Efficiency, essentially working with the Trump administration? Dan Ives has talked about the need for Elon to make a clean break at some point to say to people, I am not going to be doing as much with Doge, or I'm done with Doge. I'm not sure we get that, Scott. I think a lot of times we go into these calls and these reports and we say we want to hear X, Y, and Z from Elon Musk. You know how many times we hear X, Y, and Z? Not that often. We will hear parts of what we want answers to, but we may not get definitive answers on everything.
True, but it's not that often that Tesla gets cracked 50% going into a print either. So we'll see. It just raises the stakes even further. Phil, thank you. We'll see you, of course, with these numbers when they hit. Gene Munster of Deepwater owns Tesla shares personally. So does CNBC contributor Bryn Talkington, Requisite Capital, with me both now, as you see. Bryn, you first. There's a laundry list in front of us today of what is incredibly important. What's most? Tariffs, gross margins, brand damage, new model delays, autonomous, Musk. You pick.
You said it right there. I mean, you captured it. I agree with Phil, and I hope Dan Ives is right that he says he's going to focus on Tesla. I think he can focus on 10 different things. We've all seen that. But understand he does what he wants to do because he has these incredibly strong beliefs, whether you agree with him or not. And so I don't know if he would say he would be stepping away from Doge. I think that I agree with Phil. I don't even remotely think that that's a high probability. I think it would be helpful for Tesla investors. But I think really what we want to understand is guidance, is that from a car company where 80% of the revenue, 80% of the revenue comes from cars today, 20% is guidance, and also what's happening in China. Because I've talked about this a lot. China is where the EV, you have to sell cars in China, and there's so much competition. Tesla is still looked at as a luxury brand, but it kind of feels like when you look at all of the other XPeng, Li, BYD, there's somewhat of a race to the bottom of just pushing out all of these cars. So I really want to hear about China. I think Tim Cook, Jensen, and Elon probably have the best relation with the Chinese government, and so I think that's going to be incredibly important in terms of what type of guidance are we going to see in China versus the U.S. or Europe.
So interesting, Gene. It so much underscores as well the current environment that we find ourselves in, that when I present Bryn with a laundry list of issues, she starts with all roads lead to Elon. And
but it's going to be costly in 2025.
What gives you the confidence, though, that they can turn this around? It remains unclear as to what level of brand damage has been done. Seems there's been some, and how lasting it might be.
So I'm in the view that this is not a car company. I think that the autonomy piece, understanding Elon's a great salesperson, but it resonates what they're doing. I think if you look at which companies are the most advanced when it comes to physical AI, it's probably Tesla and Anduril. And so when I think about that question about cars, and I think that there's just a higher order that's going on. They got to get the car business. They got to get through the brand damage. That's all going to happen. It may take 6 months. It may take a year, but they're going to get through it. And eventually, customers are going to vote on the merits. Is this the right car for the right price? And I still think that Tesla stands above the competition when it comes to not only range and price, but also what the future car could be like around autonomy. And so that's when I talk about the rocket ship. I'm just a firm believer that physical AI will take longer but be more impactful. And I think Tesla, no one's even close. Elon referred to it last quarter as you need a telescope to see the one who's in second place, and he's right.
You know, Bryn, do you agree with that? That this picture painted of a 6 months to a year turnaround from a brand revival, if you want to call it that, if in fact it needs it? I mean, it seems to be pretty accepted at this point that there's been some degree of brand damage caused by Musk's heightened role in politics. Is that something that you see turned around in 6 to 12 months?
Well, if the economy's doing well, sure, right? It's all about execution. And so I don't think I think the brand damage, people have a very short-term memory, but I think what he's actually doing, and look at the robotics side. I mean, look at Aptronic, which is an Austin-based robotics company, doing a huge raise right now. There's so many other companies, VC companies, very well funded doing robotics. I feel that with XAI, with the robotics, with the autonomy, with the energy storage, I feel that investors will see if this is a kitchen sink quarter, or the next two are, but investors are going to look forward and say, he has been able to deliver long term. It always takes longer. I would be so surprised if there were any robotaxis in Austin in June. It just always takes longer than what he says it's going to take. But I think this is a great year. You know, I mean, the price entry point matters, but as you know, I sell calls on this name. There's huge call premium, a ton of volatility, but this is where you step into a name where there's so many reasons not to buy the company. But if you believe in the execution of Elon and his team, by the way, because it's not just him and his team, I think this year sets up to be a good entry point for future years. But make no mistake, they have to execute, and you can't have earnings continue to degrade, revenues continue to degrade. That will only work for so long.
Yeah, I mean, it's the numbers don't lie, Gene. You are what your record says you are. They are what their gross margins are going to be reported as. The number, as you said, is 11.6 expectation, could be single-digit whisper. General Motors does 10% gross margins.
General Motors doesn't have a future business. That's the difference, is that, agree, Scott, the numbers matter in the long term, but again, they're going to paint this as big investment year and no one's close. And Elon does a great job of selling people, and I think largely, I'm not saying the stock's not going to be down tomorrow. What I'm saying is that it's going to be higher in a year from now.
We'll leave it there. Thank you very much, Gene and Bryn.
Thank you.
All right. Bryn's going to stick around. Then there is Apple, getting a nice boost today after influential analyst Eric Woodring put out a report on iPhone upgrades. Our tech reporter Steve Kovac, he joins us now with the details. It was pretty optimistic and maybe surprising in some corners.
Yeah, that's right, Scott. I got two takeaways from this survey. By the way, this was for U.S. customers who own iPhones already. Let's talk about the two that we got here. First, there's Apple Intelligence, and then the new iPhone designs. Let's start with AI, though. This survey says 80% of U.S. iPhone owners have used Apple Intelligence, if they have a compatible device, of course, but just a 53 Net Promoter Score. Woodring says that's surprisingly positive, but that Net Promoter Score is actually pretty mild. So it really shows a supermajority of users have tried Apple Intelligence, but a lot of them aren't super enthusiastic about it. Remember, Woodring actually lowered his iPhone sales estimates after Apple delayed that Siri AI update earlier this year. But let's put AI aside, and things look really rosy on the hardware front ahead of the iPhone 17 launch coming up this fall. The survey says 51% are extremely likely to upgrade their iPhone within the next 12 months, and 60% are currently using an iPhone that's at least 3 years old. That happens to be the sweet spot for folks who want to upgrade. And the excitement around new designs and form factors, that's Apple's bread and butter, right? Survey says here 40% are extremely interested in upgrading to rumored changes to the iPhone. That means things like the super thin iPhone 17 that's rumored to launch this fall, and a foldable iPhone that could come as soon as next year's iPhone 18 cycle. So the way I take it here, Scott, not a lot of enthusiasm necessarily around AI, but plenty around the hardware and new designs.
Yeah, and I mean, that's what arguably matters most.
Indeed.
Getting the upgrade. Steve, thank you. Steve Kovac. Eric Woodring, by the way, of Morgan Stanley, will be with us on this program tomorrow. So you hear directly from him, and we look forward to that. To Christina Partsenevelos now for a look at the biggest names moving into this close. Hi, Christina.
Hi, Scott. Well, let's start with Northrop Grumman shares. Worst performer right now on the S&P 500 after the defense firm posted a 49% drop in Q1 earnings and cut its full-year outlook. It took almost a $500 million hit from its B-21 aircraft program as the company tries to ramp up production. Shares are down 13% right now. Meantime, Pulte Group shares are in the green after the home builder reported a beat on the top and bottom line. The average home sale price climbed 6%, so the average price is now $570,000, but was also offset by a 7% decrease in closing volume. Shares, though, are still up almost 8%, Scott.
Okay, Christina, thank you. Come back to you in a bit, Christina Partsenevelos. We're just getting started here. Up next, Treasury Partners Rich Saperstein tell us where the best opportunities are right now in this market. He'll be here at Post 9 next.
Before they talk to Wall Street, they talk to John Ford and Morgan Brannan. Closing bell overtime.
This is CNBC on assignment at L'Oréal's U.S. Research and Innovation Center.
Pledge is to invent the future of beauty, and therefore to do that you need the future of research centers, and that's exactly what's being built here, potentially the blueprint for our future R&D centers around the world. And it's going to serve the USA, our #1 market, but not only, because here will be invented new formulas that will serve consumers all around the world.
With a competitive beauty market constantly evolving, innovation is crucial to stay ahead. Consumers now seek products that cater to their unique skin tones, textures, and concerns rather than one-size-fits-all solutions.
Personalization is definitely the future of beauty. Real personalization is also what I would call the ideal curation, is giving you the most precise recommendation of existing products, but which combination will be perfectly matching your needs, your skin tone, or your hair type.
So this is the best dish to me in Vietnam. Good childhood flavor.
Hi everyone, my name is Thủy Tiên and welcome to Ho Chi Minh City. Lotto is the name of the game, just like bingo in America.
Vietnamese people drink coffee every day. If you drink the Vietnamese coffee, you can recognize the difference in the Vietnamese Robusta beans. It's a very strong, very resilient beans. Bitter.
I think it's quite hard to the foreigner to imagine what they have in Cơm Tấm. You can find a lot of different kind of seafood here because we have a long coaster. It's like the time when you feasting and socializing with your friends and family. 1, 2, 3, go! Join me during my downtime.
Rally on our hands today, and we are rallying into the close, rebounding after that sell-off yesterday. My next guest says while he expects more volatility ahead, he is finding pockets of opportunity within equities. Joining me now at Post 9, Rich Saperstein, Treasury Partners. Nice to see you again.
Likewise.
Where are these opportunities in stocks?
Well, markets right now are discounting the impact on the global financial situation from all the fuses being lit in Washington, and that's obviously the Doge, the layoffs, and cuts and
everything.
all the tariffs and everything. So I think we're going to have continued volatility. We're going to see reduced earnings. And I think that over the next 2 quarters, there's really no rush to aggressively go into the market and put capital to work.
So you literally would advise people just sit on your hands for a couple months. Let's just see how things work out?
It depends on how invested someone is. So if someone's not in the market, they probably should start putting funds to work
But
now.
I mean, I'm guessing that most of the people watching you right now are invested in the market to, to at least some degree. Who knows what their, cash levels are relative to how exposed they are to equities and bonds. But what if you are pretty well invested and you've enjoyed the past couple of years, you didn't sell at all on the downturn that we just had. What do I do then?
Rotate into high cash flow generating companies. So, for example, in the large cap tech space, there are certain companies that right now have operating cash flows of over close to 10%. In the utility space, as you know, I've been an owner of utilities for quite a while.
But I mean, the Vistra has been one of the most volatile stocks in the market.
Yeah, it has. Vistra is a $40 billion company generating $5.5–6 billion in operating cash flow this year. They're going to buy back stock. They're going to only be growing. So as an independent power producer, that plus NRG at these levels continue to provide great opportunities.
When you're talking about mega caps, like what? I mean, you're essentially suggesting that you think these stocks have corrected enough?
Yes.
Even if the economy gets worse?
Well, the economy will slow down. There's no question. And if we look at where the market will go, let's say last year the market generated $245 in earnings. Put a 20 on that. That's roughly a 5,000 bottom on the market.
Why would I put 20 on that?
Because that's trailing earnings, and then you'll have 26 where a lot of this tariff tantrum and this entire doom loop that we're experiencing will probably be over by then. So I think you'll start looking at increased earnings into 26, so you'll start putting a multiple of, let's say, 18 on 26 earnings. So in terms of the market this year, I'd look for Q3 and Q2 to be more turbulence, more resolution of the tariffs, leaving Mexico, Canada, Eurozone, and China for Q4, and some resolution on that.
What about things like munis, which you've told our viewers you like for a long time? 2 weeks ago, the worst day in 30 years. I know some would say, well, that's where the opportunity presents itself. But given what's been happening with the bond market and interest rates, maybe I don't feel as comfortable as I once would have with even something that feels as safe as a muni.
We haven't seen these rates in 14 years. And the reason is that there was tax selling to pay taxes on April 15th, huge supply coming into the market. This week, 13 billion versus an average of 7 billion. Plus, one of Trump's advisors suggested reducing or eliminating the tax-free nature of munis. And you have volatility in the stock market leading to selling in the bond market. So that's raised the yields on these bonds to unprecedented levels.
You'd like to lock in some of the yields that they present?
Absolutely, because if the tariffs result in a slowing of the economy, that will result in lower interest rates, and that will raise bond prices, because if yields drop on bonds, the prices go up. So as a place to hold out and hang out right now during this volatility, plus have a great long-term investment, munis at 4.5–5% tax-free are exceptionally attractive right here.
Are your clients, like seemingly everybody else, hanging on every headline that moves?
Most people are, because, Washington has really dominated the airwaves right now. And keep in mind that the tariffs today are impacting the market. And unlike 08 or 20, when we had great market declines, we had no way out of this. With the tariffs, it's one guy. He could basically start resolving a lot of these issues, making announcements.
You think he's going to do that? What do you mean we had no way out of the other things? The Fed came to the rescue, and so did the government with all the stimulus money. Neither looks imminent in this case.
Well, in 20, we had no solution for COVID when the market dropped. In 08, the Fed had to come in and really rescue the market. In this case, the Fed does not have to come in. Will Trump resolve this? Well, let's think about this. Europe, you're charging me 10% on my cars. I want to send a caddy over to Europe. It's 10% tariff. We're only charging 2.5%. Either charge me 2.5% or I go to 10. Let's just resolve this. It's a binary outcome. It's all math. So I think these agitating discussions will get resolved, unlike what we had clarity on back then.
And you don't think that enough damage would have been done before that happens to have a bad market outcome, because you essentially have an unavoidable economic situation that you're going to have to deal with first?
I'm not worried about the fact that we're losing our reserve currency status, that, foreign capital flight. I'm not worried about all these things we're hearing in this doom loop vortex.
Not worried about any of it?
Because I'm looking past all this and I'm saying, what's the likely outcome and where should we be deploying capital? Right now I'm buying munis and I've got a place to be for when this outcome occurs.
All right. Guess that's why I'm going to Italy soon. You're you. All right. Good to see you. Thanks for being here.
Great to see you,
Rich
Scott.
Saperstein, the man with no worries seemingly at all.
That's not exactly true. But
I know, but you project a very positive face in what is a very uncertain environment. I think that's my point.
It's uncertain but resolvable. That's the key. There's benefit for both sides to resolve this. So there could be some resolution that's announced over the next 30, 60 days, and you'll see the reaction in the market.
Okay. All right. It's good to see you. Let's see you soon. Rich Saperstein. Up next, Bitcoin's on the rise again today. What's behind that bounce? We will tell you coming up.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
Don't miss our all-new weekday lineup. U.S. Markets Edition, Squawk Box Asia, The China Connection, Inside India, Access Middle East, CNBC, First in Business, Worldwide.
My earliest ambition was to be a teacher, but I felt I couldn't afford it. My mother thought it was the highest calling, and I gave her a promise that one day I would be a teacher if I did well enough in life. It was my ambition, and I was able to achieve it. So now I can teach you so that you can be as ambitious as you want about whatever you want to do. CNBC is my home. If you love your work, well, maybe it's life itself.
How much would you pay for luxury travel? A week's stay costs almost $270,000.
It's on the list for $30,000.
From secret getaways to one-of-a-kind deluxe experiences and bespoke services all the way.
The next evolution of the luxury traveler is experiences. Experiences really that money can't buy.
This is First Class, only on CNBC.
Want to make some extra money, but not sure where to start? CNBC Make It will teach you the skills to earn passive income online. Take our new online course that will help jumpstart your business idea. Get expert advice and hear real-life success stories.
Soon, you'll have the tools that you need to start your own passive income business.
Learn how to start generating additional income right now. Register at cnbcmakeit.com/passive income today.
That maybe there's going to be some potential for de-escalation. Maybe there's a possibility of kind of, creating some kind of declaration of victory when it's just sort of a de facto retreat by the administration, and the market's willing to pop a little bit on that. The other piece of it is the S&P is perfectly inverse to gold today. We got those headlines about whatever Besant said yesterday, S&P up, gold down. Gold seems a little bit stretched. It's been the only real diversifier in this market for weeks. I would look at that as a way of a sort of a pressure valve that might come release.
Exactly what Verone was talking about a little bit earlier. Taking a look at that chart, it really has been straight up and to the right.
Right, and it's the only thing, and maybe it's overheated and crowded in the short term. It needs incremental stress from the trade war or bad economic numbers, perhaps, to keep going this way.
All right, Julia Borston watching Netflix for us, which is on a record run here.
That's right. Shares of Netflix hitting a new all-time high today, on track for their first close of over $1,000 per share since late February. Now, take a look at shares up about 5%. Going into the close at $1,038, they're still a little bit below the all-time closing high of $1,058.60. That record set on February 14th. Now, today's gains come after better than expected earnings on Thursday, and also on a Deutsche Bank note out today saying, quote, Netflix is perhaps the best positioned media stock in our coverage with respect to macroeconomic risk factors. Now, the stock is up over 12% so far this month and up 17% this year. Back over to you.
All right, Julia, thank you very much for that. Julia Borston, Pippa Stevens. Now tell us about these energy companies you're tracking today.
Hey, Scott. Well, Enphase is bouncing back alongside the broader market ahead of its report, where tariffs will be front and center. Enphase's storage segment has been a key growth driver, and the company imports its lithium battery cells from China. Now, Enphase did move to diversify its supply ahead of the tariffs, but China is the largest market supplier, and more broadly, the U.S. imports the majority of its solar panels, meaning this company. Still, Stifel reiterating its buy rating ahead of the print, pointing to a strong international revenue mix, as well as its LNG liquefaction segment backlog. The stock up 1% ahead of that report. Scott?
All right, Pippa, thank you very much. That's Pippa Stevens. Back to Mike Santoli. Got a little more than 2 minutes to go here. And then we're going to get pretty heavy in Tesla.
Yes.
And you got Alphabet later in the week as well.
I think the stock reactions to earnings is sort of the next thing that's going to serve as a little bit of a test or a tell for the market. Coming into today, you actually had marginally positive relative performance by the companies, the stocks of the companies that have reported already. That shows you that we've front-loaded a little bit of negative expectations about outlooks. Probably a net positive, but the reactions to the big ones obviously is going to have a lot to do with how it goes from here. I think you can almost be encouraged by the reports themselves without extrapolating to say that we can bank on that. At some point, I also wonder if we're going to be able to retreat to this idea that the U.S. economy is not particularly trade-centric or dependent on global trade flows. As much as it's creating this massive weight on CEO and business and investor and consumer confidence, it's not necessarily the make or break. So if we can get a release on the headline level from incremental escalation, do we have some kind of a window where we can take some kind of comfort in the fact that maybe actually here and now economic activity is hanging in there? I think that's obviously sounds like almost too optimistic a view, but it's something that I don't think the market has been fully priced for heading into this phase.
I mean, it's supply chain dependent.
Yeah.
There's just, at this point, little tolerance for higher prices from consumers.
That's right.
After everything they've gone through over the past few years.
Which is why the clock is ticking on when we can get a really benign de-escalation, right? Once stuff is in place for a while and businesses have to assume it's going to remain in place and consumers start to change their spending mix according to it, you're kind of sunk at that point. So I do think you really want people to be able to say, fine, let's allow the administration to find some kind of face-saving way to pull back from it. On the other hand, if you can just throw some leaked progress out there and get the market to rally, maybe they don't need to create any kind of de-escalation progress.
Well, mission accomplished at this moment.
For a day.
Thank you. For a day.
Back to yesterday's
That's
high.
Mike Santoli back with us. We're happy to have him right here at the desk with us today. Dow's going to go out with a 1,000-point gain as it settles out here in a decidedly green day. I'll see you tomorrow into overtime with Morgan and John as we await those Tesla numbers.
Well, that's the end of regulation. NASA ringing the closing bell at the New York Stock Exchange. Avantis investors doing the honors at the NASDAQ. A solid rebound for stocks. The major averages all finishing up more than 2.5% after hopeful headlines about easing trade tensions with China. Every sector closing firmly in the green. That is the scorecard on Wall Street. But the action is just getting started.
Welcome to Closing Bell Overtime. I'm Morgan Brennan, along with John Ford.
Well, can Tesla keep this comeback momentum rolling? One of the most hotly anticipated reports of earnings season is about to drop after a brutal start to the year for Tesla shareholders. And as questions swirl about Elon Musk, the polarizing figure at the head of the company. We're going to have key numbers and reaction from analyst Dan Ives and former Tesla president John McNeil.
And also this hour, David Zerbos from Jefferies will be with us to talk about President Trump's criticism of Fed Chair Powell and how the market would react if Powell were to be booted from his role. But first, breaking news on Sam Altman and nuclear energy company Oklo. Pippa Stevens has the details. Pippa.
Hey, Morgan. Well, Sam Altman is stepping down as chairman of the board of nuclear company Oklo, giving Oklo more flexibility to pursue partnerships with OpenAI or other hyperscalers, which might not have been possible with Altman at the helm of both OpenAI and Oklo. Now, Altman has been involved with the nuclear company, which makes small modular reactors for some time. Oklo went public in May of 2024 via a merger with a SPAC backed by Altman. Now, last year, Oklo signed an agreement to provide power for data center developers Switch. But so far, it has not inked a deal with a hyperscaler. And so this might change that. The stock down here some 5%. Morgan?
Okay. Pippa Stevens, thank you. It looks like we're down about 6.5% now and falling. Now let's get to today's market action, and there was a lot of action as we await Tesla results. Let's bring in Carson Group Chief Market Strategist Ryan Dietrich and Payne Capital Management Senior Wealth Advisor Courtney Garcia, along with CNBC's own Senior Markets Commentator Mike Santoli. Great to have you all here on a day where there's a lot of green on the screen.